We're taught that inflation is just numbers, a rise in prices, a dip in purchasing power, a temporary economic inconvenience. But that's a lie. Inflation is not just an economic phenomenon. It is a deliberate political tool, a silent tax, a transfer of wealth, a reset button for governments who have spent beyond their means. And like any weapon, it's pointed at someone. That someone is you. Who benefits from inflation? It's important to ask. Who wins when money loses value? Not the worker whose paycheck buys less. Not the saver watching their cash erode. Not the retiree living off a fixed income. Inflation benefits debtors, especially governments. If you owe $33 trillion, like the US government does, inflation is your best friend, because if the dollar is worth less tomorrow, so is your debt. You pay it back in weaker dollars. You shrink your burden without lifting a finger. That's not a bug. That's the plan. The debt trap and why inflation is necessary. Western governments are in a debt trap. They borrowed beyond what they can ever realistically repay. But unlike a household, they can't declare bankruptcy or just stop spending. So what do? They inflate the problem away, raise nominal GDP, let wages rise, let asset prices inflate, make it look like the economy is growing, even if it's just the currency shrinking. Meanwhile, real living standards decline, but nobody protests because the numbers still go up. Your salary might go from $70,000 to $80,000, but if rent and groceries rise faster, you're poorer. The stock market might hit new highs, but it's just keeping pace with currency debasement. Home prices surge, locking younger generations out of ownership. It's economic gaslighting. You feel poorer, you're poorer, but the system keeps insisting you're not. Why politicians love inflation? Inflation gives government everything they want without the political consequences. Need to fund a war, stimulus, or welfare expansion? Just print. Need to avoid raising taxes? Inflate instead. Need to shrink the debt to GDP ratio? Inflate GDP. The best part? Most people don't understand it. Inflation is invisible. It creeps up slowly. By the time you feel it, it's already too late. And when people get angry, politicians just blame corporate greed, supply chains, or unexpected shocks. Never their own policies. The great wealth transfer. Inflation isn't just a hidden tax. It's a massive transfer of wealth from the poor to the rich. Here's how it works. The rich own assets, stocks, real estate, businesses. The poor hold cash and wages, which lose value fastest. When inflation hits, asset values soar while cash burns. So who wins? The landlord, not the renter. The investor, not the paycheck worker. The government, not the citizen. It's feudalism in modern form, where the lords own the land and the peasants pay in devalued coin. Modern monetary theory and the new economic religion. In recent years, a dangerous idea has gained traction. Modern monetary theory (MMT). MMT says deficits don't matter, that governments can spend as much as they want because they print the currency, that inflation can always be managed later. This isn't economics, it's ideology, a seductive fantasy that allows politicians to promise everything without saying how they'll pay for it. Free college, universal healthcare, debt forgiveness, climate packages, wars, all paid for by printing money. It's political alchemy. Turn paper into promises, turn promises into votes, and when the inflation comes, just blame someone else. Weaponizing inflation against the middle class. Inflation doesn't hit everyone equally. It targets the middle class, the very people who play by the rules. Save diligently, avoid risky debt, work for a salary, invest in bonds or pensions. But when inflation runs hot, savings are destroyed, wages lag behind, conservative investments underperform, and suddenly, the people who did everything right are falling behind. That's not an accident. That's the system working as designed. Because in an economy fueled by debt, savers are liabilities, and the only way to survive is to speculate, to borrow, to leverage, to gamble. Inflation pushes people out of prudence and into risk, which keeps the casino running. Central banks know this, and do it anyway. Don't be fooled. The people running the system understand all of this. They know QE fuels asset inflation. They know low rates widen inequality. They know that inflating debt helps governments escape accountability. But they do it anyway, because they don't work for you. They work for the system. A system that rewards risk, punishes savings, and runs on the illusion of infinite growth. Inflation is not an accident. It's not temporary. It's not unexpected. It's policy. Inflation versus freedom. In a truly free society, money is neutral. It holds value over time. It allows long-term planning. It rewards discipline, patience, and prudence. Inflation erodes that freedom. It forces you to spend now or lose purchasing power. It forces you to invest recklessly or fall behind. It turns every paycheck into a countdown, every savings account into a leaky bucket, and every citizen into a hamster on a wheel, running faster just to stay in place. That's not freedom. That's economic control. Why it feels like you're always behind. Ever wonder why your grandparents could buy a home on one income? Why a single job used to be enough? Why pensions and savings once worked? Because money used to mean something. Before 1971, when the US left the gold standard, the dollar had discipline. You couldn't print without consequences. Now, we print at will, and the result is a system where nothing feels stable anymore. Rent rises faster than your raise. Health insurance eats your paycheck. Groceries cost double in 2 years. Your savings buy you less every Christmas. You're not crazy. You're not lazy. You're not failing. You're being inflated out. Inflation is not some neutral force of nature. It's a tool used by those in power to manage dissent, dodge accountability, and extract wealth. And the worst part? You don't see it coming until it's too late. But now you do. In the next chapter, we'll pull back the curtain further and explore how currency itself is being weaponized and how the dollar, once the world's safe haven, might become its biggest liability. Because in the end, inflation is just a prelude. The real collapse begins with trust in the currency itself. We've talked about debt, inflation, central banks, and silent taxation, but all of it rests in one fragile pillar: trust. Trust that a piece of paper or digital number has value. Trust that your government is solvent. Trust that your savings mean something. And when that trust dies, so does the currency. The global power of the dollar. For nearly a century, the US dollar has been the foundation of the global economy. It's the world's reserve currency. Oil is priced in dollars. International trade flows through dollars. Countries hold trillions in US bonds as safe assets. Why? Because America, for all its flaws, was trusted. It had a stable democracy, a powerful military, a deep financial system, and for decades, it was a relatively responsible steward of its currency. But that trust is cracking. A slow-motion collapse that fall of a currency isn't like a car crash. It's like a slow leak in a dam. First, foreign countries start reducing dollar reserves. Then, trade agreements begin bypassing the dollar. See China and Brazil. Gold purchases rise. US treasuries are sold off. Confidence quietly erodes. And then, one day, a crisis hits, and no one wants to hold dollars. When that moment arrives, it's too late to prepare. Why the dollar might be next? Let's look at the signs. Exploding debt. The US is now over $34 trillion in debt, with no political will to stop, and sustainable deficits. The government borrows more each year just to pay interest. Central bank panic. The Fed prints trillions, then scrambles to contain the inflation it caused. De-dollarization. Major economies are actively working to replace the dollar in trade. Loss of confidence. At home and abroad, people are starting to ask, is the US still the safest bet? The US is acting like a rich kid on inherited wealth, still throwing parties, still tipping big, but the money's running out. The ripple effects of a dollar collapse. See if the dollar loses its status. The effects would be catastrophic and global. Imported inflation would skyrocket in the US as the dollar weakens. Interest rates would explode. Nobody wants to lend to a bankrupt empire. Social unrest would rise as purchasing power plummets. Markets would crash. Stocks, bonds, even real estate would reel from the shock. And for the world, every country holding dollars would suffer huge losses. Think 2008. But instead of mortgages, it's the very currency system that breaks. The end of empires always looks the same. Empires don't die in battle anymore. They die from internal rot, financial arrogance, and political gridlock. They die when trust collapses faster than buildings. Rome debased its currency and fell. The British pound lost its reserve status after WWII. And now, the US, loaded with debt, weaponizing its currency, pushing endless spending, is inching toward the same fate. Could crypto or gold replace the dollar? In a post-dollar world, what rises? Gold. Possibly. It's trusted, but not programmable or easily divisible. Bitcoin or digital assets? Maybe. But governments fear losing control. A new BRICS currency? Potentially, especially if backed by real assets. A CBDC central bank digital currency? Most likely, but that comes with surveillance, control, and programmable money. Whatever replaces the dollar won't be freedom-friendly unless people are prepared. And right now, most aren't. Preparing for the unthinkable. This isn't fear-mongering. This is math. You can't print trillions, run massive deficits, weaponize your currency globally, and expect zero consequences. The collapse of the dollar might not come tomorrow, but every empire believes it's immortal until it isn't. The smart ones aren't waiting. They're diversifying. They're buying real assets. They're learning, adapting, preparing. Because in a world where trust is the currency, Knowledge is your shield. If you've made it this far, congratulations. You're already ahead of 99% of people, because while they're watching Netflix, arguing over nonsense on social media, and living paycheck to paycheck, you're waking up. You're asking the questions that matter. You're realizing that the next financial collapse won't come from Wall Street. It will come from the very institutions meant to protect us. The central banks, the governments, the unelected elite with unlimited money printers, and zero accountability. They'll say it's unexpected. They'll say no one could have seen it coming. But you'll know better. Here's your mission. Understand the system, because only then can you beat it. Protect your assets. Not just in dollars, but in knowledge, skills, and networks. Think independently, because the mainstream won't warn you. They'll distract you. And if you want more videos like this, deeper insights, harder truths, and strategies to build wealth in a collapsing system, make sure to subscribe right now. The clock is ticking, and the collapse, it's already begun. In financial circles, there's an old saying, the bond market is the smart money, and like the stock market, where hype, narratives, and short-term speculation often dominate, bonds are the domain of long-term investors, pension funds, governments, insurance firms, people who can't afford to be wrong. They don't care about memes, they care about math. So when the bond market panics, you should listen. And right now, it's not just panicking, it's screaming bloody murder. The 30-year US Treasury is a canary in a coal mine. Start with the 30-year Treasury, the so-called risk-free benchmark for long-term capital. For decades, this bond has acted like the bedrock of global finance. Mortgage rates, corporate loans, even student debt pricing, all of it rests on this yield. So when that yield explodes upward, as it has in recent months, you're not just looking at a technical fluctuation, you're looking at a signal that something is structurally broken. In late 2020, the 30-year yield was below 2%. As of mid-2025, it's hovering closer to 5%, with intermittent spikes even higher. That's not just volatility, that's a tectonic shift. Why this is terrifying: when long-term rates rise, do brutal things happen. Debt becomes exponentially more expensive. Governments have to roll over trillions in old bonds at higher rates. That means more taxpayer money goes to interest, less goes to actual governance. In the US, interest payments are already approaching $1 trillion a year, more than defense or Medicare. Assets start repricing downward. Real estate, stocks, startups, everything that was built on cheap debt starts to wobble. And in like 2008, this isn't limited to housing. This is systemic. The problem isn't just the rate itself, it's the speed of the rise. When interest rates surge this fast, it's like slamming the brakes on a car doing 100 miles per hour. The engine doesn't just slow down, it explodes. And what's worse, the buyers are disappearing. Foreign investors, once the biggest purchasers of US debt, are pulling back. China and Japan are reducing exposure. Even domestic institutions are hesitant. Why buy now when yields might rise again in a month? Why catch a falling knife? So who steps in? Who buys the debt? Answer: either no one, and yields explode, or the Federal Reserve, and we're back to printing money. That's the trap. The end of risk-free returns. The idea of US Treasuries being totally safe is foundational. Every major portfolio, from a retirement plan in Ohio to a sovereign wealth fund in Singapore, is built on this assumption. If treasuries wobble, everything else shakes. Yet here we are. Yields are surging, prices are falling, volatility is up, and worst of all, confidence is eroding, because behind the scenes, everyone knows the truth. The US can't keep borrowing like this, but it also can't stop. Tax revenues are stagnant, entitlements are growing, wars need funding, voters expect checks, and interest payments, they're compounding. This is what a sovereign debt spiral looks like. Not a default, but a slow, grinding loss of control. A world where interest eats the future. And it's not just the US, it's global. Japan's debt to GDP is over 260%. The EU is fractured between hawks like Germany and basket cases like Italy. The UK is locked in stagflation. And China, its shadow banking system is imploding. All of these economies depended on the post-2008 world. Low inflation, low rates, and endless liquidity. That world is gone. The new world, high rates, fragile growth, and panicked central banks. And yet, the institutions responsible for steering us here are still pretending they have control. The Fed's tightrope-backed Federal Reserve is now performing the most dangerous balancing act in history. If it keeps rates high, it risks blowing up the treasury market, bankrupting leveraged companies, and sparking a recession that will turn populist rage into political chaos. If it cuts rates too soon, It risks reigniting inflation, which would devastate the poor, crush consumer confidence, and destroy the last shreds of central bank credibility. There is no soft landing anymore. There is no right answer, only consequences, and the bond market knows it. That's why volatility is spiking. That's why hedge funds are piling into shorts. That's why institutional buyers are hesitant. The illusion is breaking, and unlike 2008, the villain isn't greedy banks or over-leveraged homeowners. The villain is policy. The villain is the people who claim to be in control. The world is watching. Every country in the world pegs its monetary decisions to the US. If the Fed loses control, emerging markets will implode. Currency pegs will snap. Capital will flee to hard assets. Gold, Bitcoin, farmland. A new financial order could emerge, one that no longer assumes the dollar is king. This is why the bond market is screaming. It's not just a warning about yields. It's a warning about the entire structure of the global economy, about what happens when trust, the most valuable asset of all, is lost. There was a time when central banks were seen as referees, silent, impartial, invisible hands guiding the economy. Their job was to control inflation, stabilize the currency, and support employment. They weren't supposed to pick winners. They weren't supposed to make markets. But that time is over. Today, central banks, particularly the US Federal Reserve, are no longer neutral observers. They are the biggest players in the entire economic game, and they're playing with fire. From referees to market movers, shift happens slowly, then all at once. After the 2008 crisis, central banks took extraordinary steps to stabilize the financial system. They slashed interest rates to zero. They launched quantitative easing (QE), buying government bonds and mortgage-backed securities in the trillions. This was supposed to be temporary, a response to an emergency. Instead, it became permanent policy. By 2020, central banks weren't just influencing markets, they were propping them up. In the COVID crash, the Federal Reserve intervened faster than ever before, backstopping corporate bonds, injecting liquidity into repo markets, even supporting junk debt. That wasn't refereeing. That was taking sides. The Fed put a dangerous addiction. Marks have become addicted to central bank intervention. Every time there's a dip, traders expect the Fed to step in. Rate cuts, QE, liquidity injections. It's become known as the Fed put, the belief that no matter how bad things get, the Fed will protect asset prices. This has created a perverse dynamic. Bad economic news, stocks go up because the Fed will ease. Good economic news, stocks go up because growth means profits. Risk is mispriced. Volatility is suppressed. And worst of all, investors no longer fear reality because the Fed has trained them to believe reality doesn't matter. This time, reality bites back, but here's the problem. The Fed doesn't have unlimited ammo anymore. Inflation is back, and it's sticky. The Fed's main tool to fight it is raising rates. But higher rates make the government's debt unpayable. They crash real estate. They squeeze small businesses. So the Fed is trapped. If it cuts rates, inflation flares. If it raises rates, recession hits. Either way, the trust is gone. Investors now see the Fed for what it has become, a political institution trying to manage markets, government policy, and voter expectations all at once. It can't be impartial because it can't afford to be. The illusion of independency, one of the most dangerous fictions in modern economics, is the idea that central banks are independent. In theory, the Federal Reserve isn't supposed to answer to the White House. It's supposed to operate above politics, driven by data, not emotion. But look at the past 15 years. Every major Fed decision, from QE to emergency lending to balance sheet expansion, has carried massive political implications. QE widened the wealth gap by inflating asset prices. Low rates punished savers and rewarded speculators. Stimulus coordination with Treasury blurred all lines between fiscal and monetary policy. In practice, the Fed has become a fourth branch of government, unelected, unaccountable, but with trillions of dollars in power. And the public is catching on. Trust in the Fed is declining. Populist voices on both left and right are questioning its legitimacy. Conspiracy theories about digital currencies and global financial control are gaining traction, because when you lose trust in money, you start looking for meaning elsewhere. The central bank trap. This isn't just about the US. The Bank of England is grappling with stagflation and fiscal pressure. The European Central Bank is managing a monetary union full of political dysfunction. The Bank of Japan is stuck in a twilight zone of perpetual QE and yield curve control. And all of them are staring at the same problem. Too much debt, too little growth, too few tools. Central banks were never designed for this world. They were built to fine-tune small imbalances, not to manage sovereign debt bubbles, tech-fueled asset booms, pandemic-era stimulus, and a global economy running on confidence and borrowed time. The rise of central bank tyranny. What happens when central banks can no longer steer the economy, but still wield massive power? You get monetary authoritarianism. Here's how it works. Rates stay artificially low, not because it's the right policy, but because governments can't afford higher debt costs. Inflation becomes tolerated, quietly accepted as a way to erode debt in real terms. Currency control increases by tools like CBDC, central bank digital currencies, surveillance of capital flows, and manipulation of exchange rates. Markets become reliant, not on fundamentals, but on the next policy statement. In this world, the line between democracy and technocracy blurs. People think they're voting for economic policy, but the real power lies in a boardroom in Washington, Frankfurt, or Tokyo. And the scariest part? No one voted for this. The death of free markets. Free market is supposed to reward innovation, punish failure, and allocate capital efficiently. But when central banks distort every signal, from interest rates to credit risk, the market becomes a hall of mirrors. Zombie companies survive. Housing becomes unaffordable. Young people lose faith in capitalism itself. This isn't just an economic problem. It's a generational crisis of trust. Millennials and Gen Z see a system rigged against them, and in many ways, they're right. Because when the rules change to serve the past instead of the future, you don't get progress. You get stagnation, resentment, and eventually, rebellion. Central banks were once the quiet guardians of stability. Today, they're the reluctant tyrants of a system spiraling out of control. They didn't set out to become powerful, but when every institution else failed, government, markets, media, we turned to them. And now, they can't stop. They can't stop printing. They can't stop intervening. They can't stop pretending they're still in control. And when they finally lose that control, the crash won't be temporary. It will be transformational. The next great financial collapse won't start in a hedge fund. It won't be triggered by greedy mortgage lenders. It won't be the fault of some rogue trader or a mispriced derivative buried in a spreadsheet. No, next time, the grenade will come from the safest place of all, the central banks. The very institutions designed to stabilize the economy are now the biggest risk to it. And if you think that sounds like hyperbole, stick around, because by the end of this video, you won't just believe it, you'll see it. Let's cut the noise. Most people still believe that central banks, the Federal Reserve, the European Central Bank, the Bank of Japan, are like benevolent referees in the global financial game. Calm, wise, impartial. They tweak interest rates, manage inflation, keep unemployment in check. They're the adults in the room. But that story is collapsing. Behind closed doors, central banks have become political weapons. They print money not to save the economy, but to prop up governments that can't balance a budget. They hike rates to punish inflation they created, and then panic when markets start to wobble. In truth, central banks are no longer referees. They're players, and they're bad ones at that. Just look at the US 30-year bond, long considered one of the most stable, boring assets in the world. It's spiking. The yields are rising. The price is falling. And that's not just market noise. It's a flashing red siren. Because when bond yields spike, it means confidence is collapsing. Investors don't trust the government to repay its debts without printing trillions more. And who's the printer-in-chief? The Fed. Let's be clear, this isn't a prediction of tomorrow's headlines. This is the setup, a slow-motion crash already in motion. For the past 15 years, central banks have injected trillions into the global economy through quantitative easing, near-zero interest rates, and open market operations. And for a while, it worked. Stocks went up, housing boomed, politicians looked competent, everyone got rich, on paper. But here's the Machiavellian truth. You can't print prosperity. You can only borrow it from the future. And the bill is now due. Inflation? That wasn't a surprise. It was engineered. It was the obvious, inevitable result of reckless money printing. And when it got out of hand, what did central banks do? They slammed the brakes, hiking rates at the fastest pace in modern history, from zero to restrictive in under 18 months. That's not monetary policy. That's panic. And it's tearing through the global economy like a delayed earthquake. Small businesses? Choked. Real estate? Freezing. Banks? Quietly bleeding from unrealized losses. And sovereign debt? It's no longer just high. It's apocalyptic. Trillions in debt, rolling over at higher interest rates, serviced by tax receipts that can't possibly keep up. The math doesn't work. Not for the US. Not for Europe. Not for Japan. This is the heart of the crisis. The very institution responsible for managing interest rates, the central bank, is now at war with its own government's debt burden. If the Fed keeps rates high, it bankrupts the government. If it cuts rates, inflation explodes. That's not policy. That's a trap, a checkmate. and no one's talking about it. The media still obsesses over consumer confidence, or monthly job reports, or the latest CPI print. But the real story is unfolding in the bond market, quiet, technical, but catastrophic. When long-term yields rise, the cost of debt servicing skyrockets. That forces more borrowing, more printing, more inflation. It's a doom loop, and central banks are the architects of it. They told us they could manage inflation. They couldn't. They told us they could unwind their balance sheets. They can't. They told us the system was safe. It's not. And you feel it, don't you? Even if you don't watch the markets, even if you don't care about central banking, something in the world feels off. Food is more expensive. Rent is absurd. Asset prices are detached from reality. And yet the narrative hasn't caught up. We're still pretending this is normal. It's not normal. It's artificial. It's delayed pain dressed up as recovery. And the central banks are the ones who delayed it. This video is not a conspiracy theory. It's not anti-government paranoia. It's not doom for clicks. It's data. It's logic. And it's happening. This is the financial reality no one wants to admit. The very people entrusted to protect our economic stability are now the greatest threat to it. It's time we stopped idolizing them. It's time we started asking, what happens when the central banks lose control? And more importantly, how do you protect yourself when they do? This isn't just about economics. It's about power, about control, and about how everyday people, savers, workers, investors, are going to pay the price for a game they didn't even know was being played. Over the next 5 chapters, we're going to break this all down. How we got here, and how the rescue from 2008 set the stage for a bigger collapse. Why the bond market is quietly screaming that something is wrong. How central banks became political, not economic institutions. Why inflation is no longer the problem, but trust is. And finally, what this all means for you. Your money, your freedom, your future. If you're serious about understanding power in the modern world, not the political kind, but the structural kind, then you need to understand central banking, because this is where the real control lies. And soon, this is where the crisis will begin. Let's dive in. To understand why central banks are now the greatest systemic threat, we need to rewind. Not to 2020, not even to 2008. We have to go back to 1971, when the US decoupled the dollar from gold. Before that moment, currency had a constraint. Gold was a physical anchor that kept money tied to reality. You couldn't print endlessly. You couldn't manipulate markets on a whim. But when Nixon closed the gold window, everything changed. The dollar became untethered.
And with it, so did the rest of the global economy.
This shift didn't cause immediate chaos. In fact, it opened the door for rapid growth. Governments had more flexibility. Markets boomed. The 80s, 90s, and early 2000s became an era of engineered prosperity, but the cost was invisible, a growing addiction to debt. Debt became the solution to every problem. Want growth? Borrow. Want to boost consumption? Lower rates. Want to juice markets? Inject liquidity. And for decades, it worked. Until it didn't. 2008.
The original sins of modern central banking, the global financial crisis of 2008, was a pivotal moment, not just for the economy, but for central banks themselves.
What started as a housing bubble spiraling into a banking collapse soon became something much deeper, a full-blown crisis of confidence in the system. The Federal Reserve stepped in. Interest rates were cut to zero. Quantitative easing began, trillions in newly created dollars used to buy assets and backstop the financial system. The goal? Restore stability and stimulate recovery. But here's the twist. That emergency became permanent. Rates stayed at zero for nearly a decade. The Fed's balance sheet exploded, from under $1 trillion in 2007 to over $4.5 trillion by 2015. The ECB followed suit. So did the Bank of Japan. Central banks became market makers, not just referees, but participants. And their new drug of choice, cheap, infinite money. What was supposed to be temporary intervention became structural dependency. Instead of forcing banks, businesses, and governments to reform into leverage, central banks papered over the cracks. They created a world where risk had no consequence, where failure was not allowed, and where the illusion of stability replaced actual strength. That's how we got zombie companies, firms that can't survive without low interest rates. That's how we got governments spending recklessly, assuming the Fed will always be there to buy the debt. That's how we got stock markets that no longer reflect economic reality, but central bank sentiment. The rescue of 2008 sowed the seeds of the next collapse. 2020. Pandemic policy or Pandora's box? When COVID-19 hit, central banks saw their chance, or perhaps their final excuse. The response made 2008 look like amateur hour. the Fed slashed rates to zero again and added $4 trillion to its balance sheet in 18 months. The ECB launched massive asset purchases. The Bank of England followed suit. Central banks became the direct financiers of government stimulus programs, lockdown bailouts, and corporate rescue packages. To the average person, it felt like support. To markets, it was an orgy of liquidity, but underneath, it was the final step into a new era. Central banks as omnipotent institutions, able to create money at will, shape markets directly, and remove downside from almost every asset class. Except, money isn't free. That $10 plus trillion printed globally, it didn't just vanish into spreadsheets. It fueled bubbles, it ignited inflation, and it created a global economy addicted to conditions that were never meant to last. 2022 to 2024, reality returns with a vengeance. Inflation roared back, not as a short-term supply chain issue, but as a structural firestorm. And the arsonists? The central banks themselves. Suddenly, they panicked. Rate hikes came fast and hard. The US went from 0% to over 5% in a matter of months. The ECB and Bank of England followed. Overnight, the era of free money ended. But the damage was already done. Markets cracked. Real estate froze. Tech valuations collapsed. And underneath it all, the global bond market, the bedrock of modern finance, started flashing red. Why? Because the math no longer worked. Governments had borrowed too much. Companies had built models around 0% interest rates. Consumers had levered up on credit. And now, everyone's underwater. And the central banks? Trapped. If they keep rates high, they bankrupt their own governments. If they cut them, inflation surges again. It's the perfect trap, one they built themselves. This is the endgame of decades of easy money, backstop markets, and moral hazard. And the next chapter is no longer about avoiding collapse. It's about managing the consequences.